What if, one ordinary morning, everyone decided to withdraw their money from the bank at the exact same time? Imagine the lines, the confusion, the growing sense of panic as people realize something isn't quite right. Here's the secret. Most of the money you think is in the bank isn't actually sitting there, waiting for you. The vaults aren't overflowing with cash. In fact, they're mostly empty. Banks aren't just storage lockers for your cash. They're intricate webs of trust and confidence, built on the belief that not everyone will panic and demand their money at once. The entire system relies on this delicate balance. When you deposit your paycheck, the bank doesn't keep it locked away. Instead, it's quickly lent out to someone else. Maybe a business owner, a home buyer, or another customer needing a loan. Your money is always on the move. The balance you see on your banking app is really just a digital IOU, a promise from the bank that your money is there, even if it's already been lent out. This is called fractional reserve banking. It's the engine that powers our economy, allowing money to flow and businesses to grow. But it's also a hidden weakness, a potential fault line beneath the surface. Think of it like a coat check at a busy theater. You hand over your coat and get a ticket. But behind the scenes, the attendant is renting out the coats to make extra money, trusting that not everyone will return at once. If, by chance, everyone comes back at the same time, there simply aren't enough coats to go around. People are left waiting, frustrated, and worried. That's banking in a nutshell. More tickets than coats, more promises than actual cash on hand. The system works only as long as everyone trusts it will. Most of the time, everything runs smoothly. People deposit, withdraw, and transfer money without a second thought. But if that trust cracks, if people start to worry the money isn't really there, the system can unravel with shocking speed. The numbers on your screen are just promises, not piles of cash stacked in a vault. It's all built on faith in the system. The entire financial world depends on stable assets and calm, confident depositors. As long as people believe, the system holds. But if either one wobbles, if assets lose value or depositors lose faith, everything starts to shake. In March 2023, at a California bank serving the tech elite, the fire alarm sounded. Suddenly, everyone rushed for the door, desperate to get their money out first. The illusion of safety was about to shatter, revealing just how fragile the system really is. Silicon Valley Bank was the tech world's bank, a financial institution woven into the very fabric of Silicon Valley's innovation engine. For decades, it was the go-to place for startups, venture capitalists, and entrepreneurs chasing the next big thing. Nearly half of all U.S. venture-backed startups banked there, making SVB a central pillar of the tech ecosystem. Its client list read like a who's who of the startup world, from scrappy founders to unicorns. During the pandemic tech boom, billions poured in. The world was suddenly online, and tech companies were flush with cash from investors eager to fuel the digital revolution. Startups parked their cash at SVB, swelling deposits from $60 billion to nearly $200 billion in just 2 years. A staggering, almost unimaginable leap. But too much money is a problem for a bank. It's a strange dilemma. Success can be dangerous if you're not prepared for it. Deposits are liabilities. They must be put to work, invested wisely, or they become a burden on the balance sheet. Startups didn't want loans. They wanted a safe place to park cash, to keep their runway long and their options open. SVB was stuck with a mountain of money and nowhere to lend it. The cash just sat there, growing by the day, with few traditional borrowers in sight. So they bought what everyone called the safest investment, long-term U.S. Treasury bonds and mortgage-backed securities. These were the gold standard of safe assets. These weren't risky subprime bonds, just boring, government-backed debt, the kind of investment that's supposed to help you sleep at night. It seemed prudent, conservative, safe. No one questioned the wisdom of this move at the time. But this safe move set the stage for disaster. Sometimes, what looks safest can hide the greatest risks. SVB's shelves were full, but the food was perishable. The clock was ticking, and the value of those safe assets was quietly eroding. No one gets fired for buying U.S. government bonds until they do. When the winds change, even the safest bets can turn toxic. This decision would ignite a multi-billion-dollar time bomb, one that would shake the very foundations of Silicon Valley's financial world. SVB's billions in long-term bonds looked safe, until interest rates rose. The problem wasn't the bonds' quality, but their duration. SVB locked up short-term deposits in long-term assets. This is interest rate risk. When rates rise, old bonds lose value. Suddenly, SVB's safe bonds were worth far less on the market. On paper, the bank looked fine. Accounting rules let them ignore losses if they didn't sell. But the losses were real. Over $15 billion hidden in plain sight. Meanwhile, tech startups began withdrawing cash as the boom cooled. SVB had to sell devalued bonds at a loss to meet withdrawals. The act of returning money to customers was bleeding the bank dry. Their conservative strategy had become a doomsday machine. Assets were locked up. Liabilities could vanish overnight. The time bomb was ticking and about to explode. The prudent move had become fatal. The end began quietly, almost unnoticeably, with a press release. SVB had sold $21 billion in bonds at a staggering $1.8 billion loss. For most, it was just another line in the financial news cycle, but for those who understood the stakes, alarm bells started ringing. The bank tried to raise new capital, hoping to reassure its clients and investors. But instead of calming nerves, the announcement sent a shockwave through the financial community, triggering a wave of panic and uncertainty. Venture capitalists, always alert to risk and quick to react, saw a bank openly admitting massive losses and scrambling for cash. In their world, hesitation can be fatal. In private group chats and encrypted messages, a single question spread like wildfire. Is our money safe? The uncertainty grew with every new message, every rumor, every anxious glance. Peter Thiel's Founders Fund, a major player in Silicon Valley, told startups to pull their money out immediately. Others quickly followed suit, amplifying the sense of crisis. What began as a whisper among insiders became a clear directive: get out now before it's too late. The message was simple, but its impact was seismic. The very community SVB had nurtured for decades, startups, founders, and innovators, turned against it in a matter of hours, abandoning the bank that once fueled their dreams. By morning, the panic was no longer hidden. The stock price crashed, capital-raising efforts failed, and withdrawal requests flooded in at a pace never seen before. Founders and CFOs scrambled to move millions to bigger, safer banks. SVB's systems, built for growth, were suddenly overwhelmed by the digital stampede. The digital floodgates opened, a 21st century bank run, executed at the speed of a group chat, with billions moving in seconds, not days. Trust, once SVB's greatest asset and the foundation of its success, evaporated in an instant, leaving only fear and doubt behind. The bank was under siege, its doors guarded and its future sealed. The outcome, once unthinkable, now seemed inevitable. In the digital age, the rules of panic had been rewritten. What started as a whisper became a roar that toppled a giant in a single day. Old bank runs were slow, lines around the block. SVB's was instant, digital, and devastating. On March 9th, customers tried to withdraw $42 billion in a single day, over a quarter of all deposits. No bank can survive that. SVB's cash reserves vanished in hours. Selling more bonds only deepened the losses. Most depositors were businesses, not individuals. Over 90% of deposits were uninsured. For startups, this wasn't about investments, it was about making payroll. The stakes were existential. CEO Greg Becker pleaded for calm, but loyalty is a luxury in a crisis. The VCs had already decided, get out. The run was unstoppable. By day's end, SVB was insolvent, with a negative cash balance. The darling of Silicon Valley collapsed in less than 48 hours. The digital age had made panic faster and more lethal. The system had no defense. When a bank fails, fear spreads fast. SVB's collapse sent shockwaves through the financial system. Depositors at other regional banks panicked. If it happened to SVB, could it happen to them? Signature Bank in New York, with similar risks, was next. Customers rushed to withdraw funds. Regulators feared a full-blown crisis and acted fast. Within days, Signature was seized, the third largest bank failure in U.S. history. The government guaranteed all deposits at SVB and Signature, even those above FDIC limits. Critics called it a bailout for the wealthy. Officials called it necessary to stop contagion. The panic was contained, but trust in the system was shaken. Behind the headlines, the SVB collapse was a human crisis. Thousands of business owners and employees faced ruin, payrolls frozen, savings locked away, social media filled with stories, a craft wine company's life savings gone, non-profits unable to serve communities, Etsy sellers cut off overnight. These weren't reckless gamblers, they just trusted the wrong bank. All weekend, founders scrambled for emergency loans, trying to reassure teams while masking their own panic. The government's decision to backstop deposits brought relief, but the scars remained. The episode exposed the fragility of the modern economy. A company's fate could be sealed in 48 hours by decisions made far away. Trust, not technology, is the real foundation of finance. When trust breaks, the consequences are deeply personal. At the center of it all, the Federal Reserve. The Fed's low rates fueled the tech boom and SVB's deposit surge. Then, to fight inflation, the Fed hiked rates, crushing the value of banks' bond portfolios. The very tool to fight inflation destabilized banks like SVB. The Fed knew the risks, but had to choose tame inflation or risk bank failures. After SVB's collapse, the Fed kept raising rates but also launched emergency lending to prop up banks. The new Bank Term Funding Program let banks borrow against devalued bonds at face value. A quiet bailout. It stopped the panic but didn't fix the underlying problem. Many banks still sit on huge unrealized losses. The Fed is piloting through a storm, every move creating new turbulence. SVB's collapse was a stress test for the whole financial system, and the results were sobering. Social media, digital banking, and uninsured deposits make bank runs faster and more dangerous than ever. The old safeguards are outdated. The system is fragile. Our bank balances are digital promises, not piles of cash. The government's ad hoc guarantees create confusion and moral hazard. If you're big enough, you get bailed out. The March 2023 crisis was a patch, not a solution. We trust our money to systems we barely understand, protected by rules that can change overnight. The story of SVB is a reminder. Finance is built on confidence, fear, and herd behavior. As we trust digital numbers on a screen, we must ask, what are we really trusting, and how safe is it? The illusion of safety is just that, an illusion.